So in this video, we are going to solve questions on amortization and sinking fund. So let's look at the first question. So which is question 1. A customer has instructed his bankers to transfer 400 Ghana cedis from his current account to his savings account at the end of each year. For 4 years. Interest rate on savings is 10% per annum. What is the size of the saving account? At the end of the 4th year, show sinking fund schedule to show the growth of the fund. So the question is asking us to calculate the size of the savings at the end of the 4th. So using sinking fund schedule to show the growth of the fund for the 4 years, right? So from the question, we know that 400 Ghana cedis is to be paid each year for the next 4 years. For how many years? 4 years, which is our end, at the interest rate of 10%. So in this case, the first question is asking us to calculate the size of the fund at the end of the 4 years. What we have to do is that we know that this is a periodic payment, right, for every 4 years. So we use a future value annuity formula, which is our future value is equal to our periodic payment or deposit, bracket open 1 plus r to the power n minus 1 all over r. Here, our r is the interest rate, annual interest rate. Our n is the number of years. Our PMT here is the yearly deposit. We use the future value annuity formula to get the size of the fund at the end of the 4 years. So we know our periodic deposit or yearly deposit is 400 Ghana cedis, bracket open 1 plus 10%, which is our interest, to the power 4 minus 1 all over 10%. Our future value is equal to 400 bracket open. So when you use your calculator to calculate bracket open 1 plus 10% bracket close to the power from all minus 1 all over 10%, you get 4.641, right? So when you multiply that 4.641 times 400, you get 1856.40 Ghana cedis. So therefore, our future value, which is the size of the saving account at the end of the 4th year, will be 1,856 Ghana cedis. Looking at the sinking fund schedule, right? First of all, we know sinking fund, we are doing a saving to achieve a lump sum. If it's amortization means that you've gone for a loan and you are showing a schedule in paying off that loan. So at the end of the day, you realize that if it's amortization, your final value will be 0. But if it is sinking fund, you are starting from what you are being saved to a final amount. So we know that we have how many years? We have year 1, year 2, we have year 3, we have year 4, right? And we know that it is the savings or the deposit are to be done at the end of each year. So at the end of year 1, we are going to deposit 400 Ghana cedis. So that will be the same closing balance of 400 Ghana cedis. So which will become the opening balance for year 2. Right, 400 Ghana cedis. And when we calculate our interest rate on which is 10% on the opening balance of 400, we'll get 40 Ghana cedis. So also we are going to do another deposit, which is 400 Ghana cedis. So when we add 400 Ghana cedis plus 40 Ghana cedis plus an additional 400 Ghana cedis, which we deposited for year 2, we'll get a total closing balance of 840 Ghana cedis. So this 840 Ghana cedis will now become our opening balance, right, for year 3. Then we'll calculate our interest earned on this 840. So when we calculate interest earned on this 840, we'll get 84 Ghana cedis. Then we'll do another yearly deposit for year 3. So when you add 840 plus 84 plus 400 Ghana cedis, which is the deposit for year 3, we'll now get a total balance of 1,324. So this 1,324 will now become the opening balance for year 4. So we'll calculate our interest rate of 10% on this opening balance, right? We'll now get an interest earned of 132. So this interest earned of 132, and we'll do additional deposit for year 4, which is at the end of year 4, which is 400 Ghana. So when we add 1,324, which is the opening balance, plus the interest earned on this 1,324, which is 132, plus the 400 deposit that we've done for year 4, we'll get our final balance to be 1,856, which is a lump sum at the end of the 4th year. So let's look at question 2, right? Assuming the customer's instruction to the bank was that the first transfer should be made now. So the instruction is that the first transfer should be made now, followed by the same amount of 400 Ghana cedis for 3 more years. What is the size of the account after 4 years? Show sinking fund schedule to show the growth of the fund. So this one means that the deposit is done at the beginning of each year, right? So we are using sinking fund schedule to show the growth of the fund at the end of the 4th year. So from the question, we know the periodic deposit is 400 Ghana cedis. For how many years? 4 years. The interest rate here is 10%. So we are using the first question interest rate of 10%. So in this case, because the deposit is done at the beginning of each year, we are going to use future value annuity due formula. So we know that our future value annuity formula is our PMT, which is a periodic deposit or yearly deposit, bracket open, 1 plus R, which is the interest, bracket close, to the power n minus 1, all over R, bracket close, times 1 plus R, right? So this is when the deposit is done at the beginning of the year. We know our periodic or yearly deposit is 400 Ghana cedis, bracket open, 1 plus 10% is the interest, bracket close, to the power 4 minus 1, all over 10%, bracket close, bracket open, 1 plus times, bracket open, 1 plus 10%, bracket close. So using your calculator for this, you get, using a calculator to calculate 1 plus 10%, bracket close, to the power 4 minus 1, all over 10%, you get 4.641, right? Then times 1.10, right? So when you multiply 400 times 4.641 times what? 1.10, you get 2,442.04, which at the end of the day, your final future value will be 2,042 Ghana cedis. So using the sinking fund schedule, right, we know in this case we are starting at year 0 because we are making the deposit at the beginning of the year, right? So we start from year 0, 1, 2, 3, 4, right? So that means the deposit is done at the beginning of year 1, which is the ending of year 0. So at the ending of year 0, we make a deposit of 400 Ghana cedis, which will be the closing balance, year 400 Ghana cedis. So this 400 Ghana cedis will now become the opening balance for year 1. So then we'll calculate our interest rate on it, which is 10% times the 400 Ghana cedis, so which will give us 40 Ghana cedis. Then we'll make the deposit, we'll make the 400 Ghana cedis deposits for year 1. So when we add 400 plus 40 plus 400, we'll get 840 Ghana cedis. This 840 Ghana cedis will now become the opening balance for year 2. Then we'll calculate our interest on 840, we'll get 84 Ghana cedis. So when we get that, we'll now make the same deposit, which is 400 Ghana cedis for year 2. So when we add 840 plus 84 plus 400, we'll now get 1,324 Ghana cedis. So this 1,324 will now become the opening for year 3. Then we'll calculate interest on this 1,324, which is 10% on it. We'll get 132 Ghana cedis. Then we'll make our deposit of 400 for year 3. So when we add 1,324 plus 132 plus 400, we'll get 1,856 Ghana cedis. So this 1,856 Ghana cedis will now become the opening balance for year 4. We'll now calculate interest on 1,856. So in this case, we'll get 186. But because we are making deposit at the beginning of each year, so that means as at year 4, we won't make any deposit. So we won't make any deposit as at year 4 because we've already done the deposit at the ending of year 3, which is the beginning of year 4, right? So when we do that, when we add 1,856 plus 186, we now get our future value, which is the lump sum of 2,042 Ghana cedis. Let's look at question 3. Claim Board Limited has bought an asset with a lifespan of 4 years. At the end of the 4 years, a replacement of the asset will cost 12,000 Ghana cedis. In this direction, the company has decided to provide for this future commitment by setting up a sinking fund account into which equal annual investment would be made at the end of each year. Interest rate on the investment will be 12% per annum. A. Calculate the annual installments. B. Draw up a sinking fund schedule to show the growth of the fund. So from the question, we know that the number of years that the investment is going to take is 4 years. We know that the future value that they are saving for is 12,000 Ghana cedis, and the interest rate is what? 12%, because at the end of the 4 years, they want to replace a machine which is costing 12,000 Ghana cedis. So in this case, we have to use our future value annuity formula, because we want to know an annual installment that they have to do in order to pay a future value of 12,000 Ghana cedis. So we use our future value annuity formula, which is our periodic deposit or installment in bracket open 1 plus r to the power n minus 1 all over r, right? We know our future value to be 12,000 Ghana cedis. We don't know our PMT, which is the annual installment, but we know our interest rate to be 12% per annum for the number of for 4 years minus 1 all over the same 12%. Our 12,000 is equal to PMT. So when we use our calculator and we calculate bracket open 1 plus 12% to the power 4 bracket close, when we use our calculator to calculate bracket open 1 plus 12% bracket close to the power 4 minus 1 all over 12%, we get 4.7793. So we have 12,000 is equal to PMT times 4.7793. So we now make our PMT the subject. So we're making our PMT the subject. We divide both sides by 4.7793, right? So our PMT is equal to 12,000 over 4.7793. Give us a final value of 2,510.83. So at the end of the day, our annual installment will now be 2,511 Ghana cedis. So using the sinking fund schedule to show the growth of the fund, we have how many years? 4 years. So we have year 1, year 2, year 3, and year 4. And the interest rate here is what? 12%, right? But the annual deposit will be done at the end of each year. So at the end of year 1, we make a deposit of what? 2,511 Ghana cedis, which will now, so that means every year we are making, at the end of each year, we are making a deposit of 2,511. So we do the same deposit for year 2, we do the same deposit for year 3, we do the same deposit for year 4. So that means the deposit is the same throughout the years. So at the end of year 1, we are making a deposit of 2,511 Ghana cedis, so which will become the closing balance. So this 2,511 Ghana cedis will now become the opening balance for year 2. So we now calculate our interest rate of what? 12% on it. So when you calculate 12% on 2,511, you get an interest of what? 301. Then we've already made a deposit of 2,511 for year 2. So when we add 2,511 plus 301 plus 2,511, we get our final value of what? 5,323 Ghana cedis. So this 5,323 Ghana cedis will now become our opening balance for year 3. Then we'll calculate 12% interest on it. So we'll now get our interest end of what? 639. And we'll make a deposit. We'll make a periodic deposit for year 3, which is 2,511. So when we add 5,323 plus 639 plus the annual deposit of or annual installment of 2,511, we'll now get our closing balance of 8,473, right? So this 8,473 will now become the opening balance for year 4. Then we'll calculate our 12% interest on it, which will be 1,017 Ghana cedis. Then we'll make our last annual deposit of 2,511. So when we do that, and we'll add that 2,511 plus 1,017 plus 8,473, we'll get our final value to be of 12,000 Ghana cedis, which is the amount that the company is saving towards to be able to replace the asset at the end of 4 years. Let's look at question 4. Buhari Limited intends to purchase a new machine costing 303,000 Ghana cedis. The fund to buy the asset are being provided as a loan by the CEO of the company at an agreed rate of interest of 12% per annum. The loan and the interest will be repayable in full at the end of the 4th year. To provide for the eventual repayment, the board of directors have decided to put an equal annual amount at the end of each year into a sinking fund to earn interest of 14% per annum, right? So A is what must be the annual payment into the sinking fund. so that the loan will be repaid after 4 years. Draw up a sinking fund schedule. So that is the question. So from the question, we know that the cost of the machine is 303,000 Ghana cedis. For how many years? 4 years. Loan interest is of 12%, right? Then in this case, we know that they are taking a loan of 303,000 Ghana cedis, right? At an interest rate of 12%. So we have to get the future value of this loan that they will be paid at the end of 4 years, right? So we have to use the future value for a lump sum, right, formula to calculate that. So we know our present value, which is the cost of the machine, which is the loan that they are taking, is what? 303,000 Ghana cedis. Bracket open 1 plus 12%, bracket close to the power 4, which will be 476,776.37. So at the end of the day, the loan amount that you pay at the end of 4 years will be 476,776 Ghana cedis. So in this case, this loan amount that you paid at the end of 4 years will not be the amount that the company will save towards. So in this case, the company will save at an interest rate of 12%. So the company wants to know the annual payment or installment that they have to make to be able to cater for the loan future amount, which is 476,776 Ghana cedis. For what? For 4 years. So in this case, we use the future value annuity formula, right? So we know our future value is equal to our PMT, bracket open 1 plus R, bracket close to the power n minus 1 all over R, because in this case the payment will be done at the end of each year, or the installment will be done at the end of each year. We know that our future value is 476,776 Ghana cedis, equal to our PMT or annual payment that we don't know, bracket open 1 plus 14%, bracket close to the power 4 minus 1, right, all over 14%. So in this case, using our calculator, for bracket open 1 plus 14%, bracket close to the power 4 minus 1, all over 14%, we will now get a figure of 4.9211. So we now have our future value of 476,776 equal to our PMT that we don't know, bracket open 4.9211. So we now make our PMT the subject. So in making our PMT the subject, we divide both sides by 4.9211. So we now have 476,776 over 4.9211. So which will give us a final value of 96,884 Ghana cedis. So that means the annual payment that they have to make into the sinking fund will be 96,884 Ghana cedis. So using the sinking fund to show the growth of the investment that they will be making, we know that payment will be made at the end of each year. And it is for how many years? 1 to 4 years. So year 1, 2, 3, 4. So at the end of year 1, we are making an annual payment of 96,884. which will become the closing balance for year 1. So this 96,884 will become the opening balance. So we'll calculate 14% interest on it. So 13,564 will become the interest earned on 96,884 for year 1. Then we are making an annual deposit of 96,884 for year 1. So when we add 96,886, which is the opening balance, plus the interest end of 13,564 plus the periodic deposit of 96,884, we'll get our closing balance of 207,332, right? So which is 207,332 will now become the opening balance for year 3. We'll calculate 40% interest on, which will get 29,026. So we are making another deposit of what? 96,884. So when we add this 3, so when we add 207,332 plus 29,026 plus 96,884, we'll now get a closing balance of 333,242 Ghana cedis for at the end of year 3. So this amount will now become the opening balance for year 4. Then we'll calculate our interest on, which will be 46,654 plus the annual deposit of 96,884. So when we add this 3, we'll now get a closing balance of 476,780, which is equal to the future loan amount that the company has to pay. So let's look at example question 5. Mrs. Alasan borrowed 200 200 million from her bankers to buy her dream house. Repayment is over 4 years and first payment is due 1 year from hence, which means that first payment is due at the end of 1 year from now. She will make equal payment to amortize both the principal and the interest, which is calculated on the reducing balance basis. The bank will charge 5% above the current base rate of 23% per annum. So that means if they are charging 5% above 23%, so it will be 23% plus what? 5%. So at the end of it, they are charging what? 28%. Right. So the question is calculate Mrs. Halassan's annual payment and show by a table how the annual payment will liquidate the loan and interest. So from the question, we know amount borrowed is 200 million Ghana cedis. For how many years? 4 years. The interest rate which is charged is 28%, which is the base interest, which is 23% plus the additional interest that they are charging, which is 5%, which will be the 28%. So in this case, we have to use the present. So because we are calculating for, we are doing amortization, because we are doing amortization, that means we have to use the present value annuity formula, right? Present value annuity, ordinary annuity formula. So using the present value ordinary annuity formula, because the loan is borrowed, which is being paid now. So using the present value annuity formula, we are going to use present value is equal to our PMT bracket open 1 minus bracket open 1 plus R, which is the interest to the bracket close to the power minus n all over R. Right? We know our present value is 200 million Ghana cedis. We don't know our PMT, but we know bracket open 1 minus 1 plus interest rate of 28%, bracket close to the power minus 4. 4 is the number of years, all over 28%. So using our calculator for 1 minus 1 plus 28% to the power minus 4 all over 20, we get 2.2410 Ghana cedis. So in this case, we know our present value, which is 200 million, is equal to PMT times 2.2410. So we'll now make our PMT the surface. So we'll divide both sides by 2.2410. So our PMT is equal to 200 million over 2.2410. Right? So you get our periodic amount that they have to pay to qualify. They have to pay for the loan annually is 89,245,872 Ghana cedis. So using the amortization schedule, we know that how many years? 4 years, because the loan is going to be repaid in 4 years time, right? So that means they're being given a loan amount of 200 million. So at the beginning of year 1, they are having a loan amount of 200 million Ghana cedis. And interest that they are going to pay on this amount to be 28% of that 200 million, so which will give us 56 million Ghana cedis. The periodic payment that they are going to do is 89,245,872. So they will do this payment every year for the 4 years. Then the principal repaid amount to be the periodic payment that they've done minus the interest rate earned, so which will show the principal paid amount that you've done, right? So which is 89,245,872 minus 56 million. So we now get 33,245,872. So to get our closing balance, we will now subtract this principal repaid from the opening balance. So the opening balance of 2 million minus principal repaid of 33,245,872 will now get 166,754,128. So this amount, which is 166.7 million, will now be the opening balance for at the beginning of year 2. So at the beginning of year 2, we'll calculate 28% interest on it, which will give us 46,691,156. Then we've already made a periodic payment of 89.2 million on it. So our principal prepaid amount will be the 89.245872 million minus the 46,691,150. So we now get a principal prepaid amount for year 2 to be 42,554,716. So we now get our closing balance. When we take this principal prepaid from the opening balance, we now get 124,199,412 Ghana cedis. So this amount will now become the opening balance for year 3. Then we calculate 8% interest on it, which will give us 34.775835 million, right? And for it, we'll do a periodic deposit, a periodic payment of 89.2 million, which our principal prepaid for year 3, which is 89.2 million minus 34.775 million, which will give us 554,470,073 Ghana cedis. So our closing balance after taking the principal prepaid from the opening balance will now give us 69,729,375. So this amount will now become the opening balance for year 4. And we'll calculate our 28 percentage interest on it, which will give us 19,524,225, and we know our principal prepaid is 89.2 million. Then our principal prepaid amount will now be 69,721,642. So when we take away the principal prepaid amount from the opening balance, our closing balance will be there. So that means at the end of year 4, using the amortization schedule, we'll be able to pay off or liquidate the loan amount. Let's look at example 6, question 6. So let's look at question 6. You have applied to your bankers for a loan for 30,000 to complete your dream house for deduction to be made over 3 years, equal annual installment. Your bankers, however, maintain that your 40% annual salary will amount to 12,000 Ghana cedis cannot meet both the principal and the interest payment. It is the bank's policy to maintain a debt service ratio of 40%. Interest charged by the bankers is 18% per annum. Calculate the size of the loan you qualify for and prepare the amortization table to show how the loan will be liquidated. So from the question, we know that our loan amount is 30,000. Our periodic payment that we qualify for is 12,000 at interest rate of 18% for 3 years. In this case, for us to know the loan amount that we qualify for, because which will be the present value, we know the periodic amount that which is based on the company's policy of 40% debt service, which is 12,000, right? So using the present value ordinary annuity formula, we have our PMT bracket open 1 minus bracket open 1 plus r to the bracket close to the power minus n over r. So we know our periodic payment is 12,000. Bracket open 1 plus 1 minus 1. We know 12 million. Bracket open 1 minus bracket open 1 plus 18% to the bracket close to the power minus 3 all over 18%. So using our calculator, we'll get 2.1743. So we now multiply the 12,000 times 2.1743. We will now get the loan that will qualify for to be 26,092 Ghana cedis. Out of 30,000, the company can only give us 26,092 Ghana cedis. So using the amortization schedule, we know we are going to pay the loan for within 3 years, which is year 1, year 2, and year 3. So our opening balance, which is the loan that we are going to get, is 26,092. We'll calculate interest payment on, which is 18% on. We'll get 4,697. Then we are making an annual payment of 12 million each year, 12,000 each year. Then our principal prepaid will now be 12,000 minus 4,692, which will be 7,303, which when we less the principal prepaid from the opening balance, we'll get 18,789, which will become the opening balance for year 2. So we'll calculate interest of 18% on, we'll get 3,382. Then we have our annual payment of 12,000. So when we calculate our principal prepaid, which is the 12,000 minus 3,382, we get our principal prepaid of 8,618. When we less it 8,618 from the opening balance of 18,789, we'll get our closing balance of 10,171. This 10,171 will now become our opening balance for year 3. When we calculate interest on, we'll now get 1,831. Then our annual payment of 12,000. So our principal prepaid will now be 12,000 minus 1,831, which will get 10,169. So when we let this principal prepaid from the opening balance, we'll get a balance of 2, which is insignificant. So that means that at the end of 4 years, we can pay the loan of 26,092 Ghana cedis. So let's look at question 7. Ubeti Limited is offering 5 million units of 15-year bond with a face value of what? 100 Ghana cedis. Though the bonds are being offered at a price of 95 each, the bonds will be redeemed at premium of 10%. The annual coupon rate of the bond is 15%. Interest is payable at the end of every 6 months. A provision in the bond indenture requires that Ubeti Limited establish a sinking fund to accumulate enough money to pay the total redemption value of the bond upon maturity. To comply with the provision, Ubeti Limited plans to set aside an even amount at the end of each quarter over the next 15 years. Each of the even amount that will be set aside will be invested at an annual interest rate of 12% with a quarterly compounder. Calculate the even amount that should be made to put into a sinking fund at the end of each quarter to raise enough money to pay the total redemption of the bond. From the question, we know the number of bonds is 5 million. It has a face value of 100 Ghana cedis. So it will be redeemed at 10%. It will be redeemed at 10% premium. So that means that the redemption value will be 100 times 1.1, which will give us 110. For how many years? For 15 years at interest rate of 12%. Quarterly compounding, which is our M year, right? So our face value at the end of the 15 years will be the 5 million times the 110, which would be 550 million, which would be 550 million, right? So using the future value ordinary annuity formula, we have our future value is equal to our PMT bracket will be 1 plus R over M. So this one is because it is compounding quarterly, so we have to divide it by the number of quarters. The power N times the number of quarters minus 1 all over R over M. So we have our future value to be 550 million. It's equal to our PMT bracket will be 1 plus 12% over 4 bracket close to the power 4 times 15 years, right? Minus 1 all over 12% over 4. So using our calculator for this, we will now get a value of 163.0834, which will get 163.0534. We will now make our PMT the service. We have 550 million over 163.0534, so which will give us a final balance of 3,373,128. So that means every year they have to put 3,373,128 into a sinking fund. So this brings us to the end of our practical session. So in our next video we'll look at other concepts under financial management. So make sure you subscribe, comment, like and share to others so that they can also benefit from this video. Thank you.